Hello, and welcome back to Forex School from Pip Insight. This course is all about chart patterns, double tops, head and shoulders, flags, pennants and triangles, and, more importantly, why they work when they work. Here's the roadmap. We'll start with the real reason patterns exist, crowd behavior around levels, not magic shapes. Then we'll study double tops and bottoms and the neckline that actually triggers them, head and shoulders taught as a structure rather than a picture, flags and pennants as pauses inside a trend, and triangles as compression before a breakout. We'll learn to project measured move targets honestly, and then spend a whole chapter on the uncomfortable truth: patterns fail, often. Everything here is education, not financial advice. Notebook out, charts open, let's begin. Why do chart patterns exist at all? Not because markets secretly love geometry. Every pattern you'll meet in this course is a picture of crowd behavior around a level. A double top isn't a shape with power, it's the visible record of buyers failing twice at the same ceiling, and everyone watching knows they failed. Patterns work, when they work, because thousands of traders see the same level, remember the same failure, and act around the same trigger. Which means every pattern in this course reduces to ideas you already know: support, resistance, and trend structure. The shape is the story. The level is the trade. Keep that sentence, the whole course hangs from it. First up, the most famous reversal patterns on any chart: double tops and double bottoms, and the neckline that makes them real. The anatomy is simple. Price rallies to a high and gets rejected. That's the first top. It pulls back, and the low of that pullback matters enormously. We call it the neckline. Buyers regroup, push back to the same ceiling, and fail again, the second top. Now, here's the part most beginners miss. At this moment you do not have a pattern, you have a range. Sellers have defended a ceiling twice, but buyers are still defending the neckline. The pattern only exists when a candle closes through the neckline, because that close proves the buyers who held the first pullback have finally given up. No neckline break, no double top, just two bumps on a chart. Let's watch one build in real time. Price climbs in confident steps until the fifth candle stalls at 128.80, the first top. Sellers press the pullback down to 128.20, and that low becomes our neckline. Buyers regroup, and the 10th candle pushes to 128.82, 2 pips past the first top, but look at the close, weak, well off the high. Second top in. Even now, nothing is confirmed, the boxed area is still just a range. Then the trigger, 2 candles later a heavy bar drives clean through the neckline and closes at 128.08. That single close changes everything. The buyers who defended the neckline are gone, and the slide that follows shows what their surrender is worth. Same logic, flipped upside down. A steady sell-off finds its floor when the fourth candle holds at 126.04, the first bottom. The bounce that follows tops out at 126.56, there's our neckline, overhead this time. Sellers try again, and the 8th candle spikes down to 126.02, 2 pips lower, but closes well off the low, a long tail of rejection. Then watch the 10th candle, it surges through the neckline and closes at 126.62. That's the trigger. Price dips briefly to retest the broken level, holds within a few pips, and climbs away. Notice the discipline in all of this: the trade was never the second bottom. It was the close through the neckline. Head and shoulders has a mystique it doesn't deserve, so let's teach it structurally. It is 3 pushes higher with a failing engine. Push 1 makes a high, the left shoulder. Push 2 makes a higher high, the head, and so far this is just a healthy uptrend. Push 3 is the tell, it stalls below the head. That's a lower high, and if you took our trend structure course, alarm bells are already ringing, because the uptrend has stopped making progress. Join the 2 pullback lows between the pushes and you have the neckline. When price closes below it, the market has printed a lower high and broken support in one sequence. Not a magic silhouette, a trend dying in plain sight. Here's the structure unfolding. The third candle tops at 129.30, the left shoulder, and the pullback rests near 128.84. Buyers drive on, and the 8th candle prints the head at 129.62, though its close is already hesitant. The next dip stops at 128.86, giving us two lows to join. The neckline sits close to 128.85. Now the third push, and it dies at 129.28, the 12th candle, well short of the head. Momentum has visibly failed. One candle later the neckline goes, a firm close at 128.78, and the following bar collapses to 128.42. Shoulder, head, shoulder, but what you really watched was higher high, lower high, broken support. From reversals to continuations. Sometimes a pattern doesn't end a trend at all, it's simply the trend catching its breath. A flag begins with a pole, an impulsive, near-vertical run that leaves no doubt who's in control. Then comes the flag itself, a shallow, tidy drift against the move, small candles sliding gently lower after a rally. Why does this pause exist? Early buyers are banking profits while new buyers queue up beneath, supply meets patient demand, and price leaks sideways instead of reversing. A pennant is the same pause with converging edges. Depth is the diagnostic, healthy flags give back only a modest slice of the pole. When price breaks the flag's boundary, the queue empties, and the trend resumes, often with the same urgency that built the pole in the first place. Watch the rhythm change. After one quiet candle the market explodes, three powerful bars carry price from 126.56 to a high of 127.84. That's the pole. Then, the exhale, for small candles drift back, each one modest, orderly, overlapping, until the flag's floor forms at 127.40. Compare the two phases, the pole covered well over 100 pips in 4 candles, the flag gives back barely a third of it. That's the shallow pause we want to see. Then the 10th candle wakes up, surging out of the flag to close at 127.82, and the very next bar clears the pole high itself. From there the trend simply resumes, the pause refueled it, and price runs on to 128.52. A triangle is what indecision looks like. Each rally tops out lower than the last, each dip bottoms out higher. The swings shrink, the candles shrink, and volatility coils tighter and tighter, like a spring being wound. Neither side is winning, but both sides are stacking orders just outside the narrowing range, stops above the falling ceiling, stops below the rising floor. That's why the eventual escape is so often violent, a small push through either boundary sets off everyone's orders at once. And here's the honest part, the direction of that break is not reliably predictable in advance. Traders using this framework don't guess. They mark both edges, wait for the close through one of them, and trade the release, not the forecast. Count the compression with me. The second candle tops at 125.60, the falling ceiling begins there. The dip finds 124.96, and the rising floor begins. Next swing, a high of 125.48, lower. Next dip, 125.08, higher. Then a high of 125.36, lower again, and by the 11th candle the entire range is 10 pips wide. The coil is fully wound, something has to give. It gives upward, the 12th candle bursts through the falling ceiling near 125.36 and closes at 125.52, the trigger. 2 candles later price is at 125.98. The pattern told us energy was building. Only the close through the boundary told us the direction. So a pattern triggers, where might it travel? The classic answer is the measured move. Take the height of the pattern, the top of a double top down to its neckline, and project that same distance from the break point. For flags, project the pole from the breakout instead. Why would that work at all? It's a rough proxy for the energy the pattern stored, the size of the battle hints at the size of the resolution. But let's be honest about what a target is. It's an estimate, not an entitlement. Price stops short, or sails past, constantly. Traders using these projections treat them as zones to reassess, pair them with real structure, and they define the risk before they dream about the reward. Back to our double top, this time with a ruler. The pattern's height runs from the tops at 128.82 down to the neckline at 128.20, 62 pips of stored energy. Project 62 pips below the neckline, and the measured target lands at 127.58. Now watch what the market actually delivers. After the trigger closes at 128.08, price slides, pauses, even bounces briefly, and our final candle reaches down to 127.78, 20 pips shy of the projection, and the chart ends there. That's typical, and it's the honest lesson. The measured move gave us a sensible zone to work towards, not a promise. A trader banking some profit along the way needs no perfection from the target. Now the chapter every honest course needs: what happens when the picture is perfect and the market says no? Time for straight talk. Patterns fail, and they fail often. Anyone teaching otherwise is selling something. There are two big reasons. First, the textbook lies by omission. Its diagrams are drawn after the fact, cherry-picked and cleaned. Real charts serve up sloping necklines, uneven shoulders, wicks that overshoot, and double tops that sit 3 pips apart instead of identical. Second, obvious patterns attract obvious behavior, and obvious behavior gets punished. When everyone sells a second top early, their stops become fuel above the highs. So hold on to this principle: the pattern is the map, the level break is the trade. And a failed pattern isn't a tragedy, it's information, and the trap it springs often powers a fine move the other way. Here's the trap in action. This looks flawless: a strong rally, a first top at 129.60, a neckline at 129.12, and an eighth candle failing at 129.58, a textbook second top. Traders who sell here, anticipating the pattern, feel clever for about 2 candles. Because look at the 10th bar, the pullback refuses to reach the neckline, holding at 129.16. That refusal is the first warning: the pattern never triggered. Then the 12th candle detonates through both tops and closes at 129.70, and every early seller's stop becomes buying fuel. The squeeze carries price to 129.96. The double top was a map of a battle. The battle went the other way, and only the neckline break, which never came, was ever the trade. Let's fold the whole course into one page. Patterns exist because crowds behave predictably around levels they can all see. The shape is only the story of that behavior. Double tops and bottoms trigger at the neckline, never at the second touch. Head and shoulders is trend structure in costume: the higher high, then a lower high, then broken support. Flags and pennants are shallow pauses that refuel a trend, and triangles are coiled indecision resolved by a breakout whose direction must be proven, not guessed. Measured moves give honest, approximate targets, zones, not promises. And above everything, the rule that keeps you safe: patterns fail often, the pattern is the map, and the level break is the trade. And that completes the chart patterns course. You can now look at any chart and do something most traders never learn: see the crowd behavior behind the shape, find the level that actually matters, and wait for the close that turns a picture into a pattern, or walk away when it never comes. Your homework: find one double top, one flag and one triangle on historical charts, mark the necklines and boundaries, and note honestly which ones failed. If this course earned it, subscribe. The next one builds these patterns into complete trading plans. And the reminder that never gets old: everything in this series is education, not financial advice. No method is a promise of profit. Trading carries real risk of loss, and every new idea belongs on a demo account first. Happy studying. See you in the next course.